What's up, y'all? This is Abdul, founder of Suja Capital and Agile Angels Collective. I want to chat with y'all for a second. So I'm talking specifically to the black folks, but this applies to everybody, but I especially want black folks to hear this. So there's a risk out there that's guaranteed to wreck your retirement. What do I mean by that? What do I mean wreck your retirement? Nobody's warning anybody about it. It ain't the stock market. It's not like a crash or nothing. It's actually what people consider pretty safe. And people think it's safe because all the typical advice out there tells you to do this. But every study out there says something about black investors. It says that we play it too safe. We're more conservative than anyone else when it comes to investing. And it's costing us billions of dollars in gains that we will never see because we don't take any damn risk. But playing it safe is actually the risk, especially when it comes from 401k, because you're giving up a lot of shit, right? So the standard stuff that everybody does, all the financial literacy advice say do, it's not bad, but 401k for retirement is almost guaranteed that you're going to come up short by the time you need that money. And this is a fact. About 65% of all Americans right now are short in their retirement funds. They don't have enough retirement funds that they need. The average American needs about $2 million to retire comfortably, not living large, just comfortably. And most folks ain't hitting that number. 65% of Americans are not hitting that number. As a matter of fact, only about 2% of Americans are hitting that number. So what does that mean? What do you should do about it? I think there's a way you can catch up, right? You can catch up. If you're behind, you can catch up, especially even later on in life. If you're still in your 20s and 30s, continue investing aggressively in your 401k, but you absolutely need to supplement that with other stuff that can give you potentially higher returns. And if you're 20 in your 20s or 30s, maybe even in your early 40s, you might can make it. Again, not on 401k alone, you have to supplement that with other stuff. But if you're in your mid 40s and over, it doesn't matter what you do in your 401ks and RRAs, you're not going to hit that $2 million number because you don't have enough time to contribute the amount of money that you would need to hit that number. So what does that mean for folks? That means you got to do something different. It doesn't mean stop doing your 401k. You absolutely should be doing your 401k, especially if you have employer matching. If your employer is matching, that is free money. Never give away that free money, right? At a minimum, you should be investing up to the max that they match. That's at a minimum. So continue doing that if that's the case. But that's not enough. The numbers bear so. The National Association of Retirement Society, I think that's the name. I'll look at that name and put it in the notes. But like I said, 65% of folks aren't hitting that number. So what do you do about that? It means you need to start investing differently. You need to add stuff on top of your 401k. It is not doing the same thing. You don't go out and get the same kind of mutual funds outside of your 401k. That's not diversity. You're just doubling up on the same stuff that you've been doing. That's not going to help. You got to do something different. You got to get into a different asset class. Almost all 401ks, employer-based 401ks, they have you guys in some type of mutual fund, right? There are different types of mutual funds, large cap, small cap, target date funds. They all have kind of different flavors and different goals, but they're all mutual funds. You can't make up the retirement gap by continuing to doing the same thing, by investing in other mutual funds outside of your 401k. That's not going to work. You got to be in a completely different asset class. And I think that asset class should be in the private markets. If you don't know what private markets is, I did a video on that too. You can look up that video. But you need to be doing something in the private markets. Private markets are more risk, but it's absolutely more reward. So that's the payoff for taking more risk. And the rewards are such that you can make up that gap because the returns are different, far greater in most cases. And on top of that, you're getting actual diversity because you're investing in a completely different type of investment, completely different than what you have in any of your mutual funds, whether it's in an ROA or a 401k or any other kind of account. Those are the two key differences. You have the potential of making much greater returns, and you have a whole different level of diversification. And normally, private markets are not correlated with the overall economy. So it doesn't really matter in most cases what the economy is doing. Your private market investments are going to operate mostly independent of that. Whereas all of your mutual funds and stocks, they're going to rise and fall along with the economy and inflation and stuff. So that's another reason why private market type investments will help in this situation. It serves as a hedge to some or all your normal investments, right? Now, there are several different types of investments within the private market world. One of my favorites, the ones that I specialize in, is angel investing. And when I say angel investing, I'm particularly talking about investing in new or young tech startups. Right? So these are investors that invested in Uber and Lyft and Facebook and Airbnb when they first got started. Angel investors are the people who were the first investors in those companies. And you can imagine how those things paid off big. So that is a really good asset class for people to look at, to give them a chance to increase their returns, add more diversification to their portfolio, as well as hedge or counterbalance the economy. But here's something that a lot of people don't realize when they start dipping their toe into the waters of angel investing. You know, people sometimes think, let me just make one or two investments or something and just kind of see how it plays out. No, that never works. One or two investments is almost guaranteed failure because there's a high failure rate with companies tend to fail at a rate of 60%, right? So if you invest in 10 companies, 6 of them are going to go out of business. So if you just invest in one or two companies, the chances are both of those companies are going to go out of business. And so that's why if you do angel investing, you need to construct a portfolio, just like you have a portfolio within your 401k, just like you have a portfolio within your Robinhood account or your Charles Schwab account or wherever you trade stocks and that kind of stuff. You have a portfolio, meaning you have several different types of investments within there. You just don't invest in one thing, you invest in multiple things. The same applies with angel investing. As a matter of fact, it's even more important with angel investing because of the high failure rates. At a minimum, you need to be doing about between 12 to 25 investments. If you do between 12 to 25 investments, you'll give yourself a chance to hit a couple of winners. Here's another pro tip when it comes to angel investing. It's just the opposite of stocks. When people invest in stocks, they want all these stocks to win. They expect all these stocks to go up. That's why they invest in them. It's the complete opposite with angel investing. You can't expect all of your investments to hit. As a matter of fact, you should be expecting that almost all of them will not hit. That's how it works. You expect that going in. But the thing is, the returns can be so big, you don't need all of them to hit. You only need 1, 2, 3 of them to hit. That is it. And that 1, 2, or 3 that may hit, one may hit it super huge, one may be pretty huge, and one may be mediocre. But between those 3 that hit, that covers all of your losses for the ones that didn't hit, plus give you a nice, healthy return. And that theory is called the power law. You can look that up. There's a statistical law called the power law, but I'm speaking specifically as it applies to the venture capital industry, which says the vast majority of your portfolio is going to go to zero, but the 2 or 3 or sometimes even 1 that wins big enough to cover all of your losses and give you a very healthy return. The power law, look it up. As a matter of fact, I'll put a link to definition and I'll write up on that in the notes. But that's how the industry operates. They know going in that they gotta make a lot of investments because a lot are going to fail. You got to have a lot of shots on goal. The more shots on goal you have, the more chance you have of getting it in the net, right? That's the same principle applies here. You got to get a lot of shots on goal. It's like, the analogy I like to use is like snapping turtles. Snapping turtles lay about 75 eggs every year, but only 10% of those eggs survive. but that 10% is enough to keep the population thriving. That same kind of philosophy applies to investing in tech startups, right? Picking the right company is important, but picking enough companies to hit a winner is even more important. So that's it. That's what I'm talking about today. Take a look at your 401k. Most of y'all are not going to like what you see. You're going to be like, damn, I've been doing this for X amount of years and this all I got, right? Most folks are thinking that. And some of y'all are thinking, shit, I need to even get started with my 401k. So if you're a professional and you working, then that's your financial fundamental. You got to be doing that. But it also needs to be supplemented with other types of investments. And one that has proven to work very well for me personally and for many others out there is investing in tech startups. And so I just want to put that nugget out there. Do your research. This is for educational purposes only. I'm not trying to give financial advice. You can take this, do your research, come to your own conclusions. If you want to learn more about angel investing, click subscribe, like this video, and I'll see you around.